Are we on the verge of a recession? That's a question we're getting a lot from clients. Steve, you want to take it from the top and give us your high-level thoughts?
Sure, and yeah, it's a question on all of our minds because as investors, we would like to have a healthy economy from which to invest within, but simply put, we don't think so. Our expectation is for positive growth, probably less than 2023 because Q3 and Q4 of 2023 came in far above expectations. 2024 starting off good. The consensus estimates from the blue chip economists are for around 1.5 to 1.75, plus or minus, depending on what side of the bed they got out of before they made their forecast. But the Atlanta Fed, which has been uncannily sharp and accurate, is looking at first quarter GDP running around a 3.8 to a 4.2% annualized number, which is, again, a pretty hot number, consistent with Q3 and Q4 of 2023, which is outstanding. Data points on some of the more high frequency or forecasted data were showing a little bit slower economic growth, but in the last month or so, those data points have turned higher. So it looks like this economic growth engine that we've got is it a soft landing or a no landing in the economy?
Well, let's talk about consumer health. We know that GDP is roughly 2/3 consumer spending. So, Steve, can you give us a little bit of a view on where you see the consumer right now?
Yeah, and this has been the real strength of the economy is the employed consumer. They've had a good run of wage increases. They have their debt pretty much nailed down on the home ownership front, with the average mortgage on for the people that hold mortgages well under 4%. And it's interesting math on home ownership, and I'll break it down a little bit because I think it's really interesting. If we figure that according to government data, 65% of citizens own a house.
Right.
Of the people that own a house, almost 40% of them don't have a mortgage. Of those that do have a mortgage, about 95% of those mortgage rates are under 4%. So that's a great base for the consumers to work with because their expenses aren't going up as interest rates have gone up. So the wages they get as inflation drops, those real wage gains or the after inflation wage gains really go to bolster their confidence. So they're in a pretty strong position relative to where they've been historically.
Can you tell us a little bit about consumer debt service payments?
That's something I was actually just looking at this morning, the debt service payments. Sometimes we get hung up about levels of debt. And yes, that's important, but levels of debt as compared to, like, for example, for the federal government, the level of debt as compared to GDP. That's an important factor, not just the level itself. And for consumers, yes, the level is important, but the amount of money that goes towards debt service as a percent of their disposable income is really the more important factor. Because on the home ownership debt front, yes, they have a gargantuan amount of mortgage debt, but the value of the equity or the value of the home that they financed has gone up in value. And yes, they picked up some consumer debt in the meantime because they've got that confidence from the house price appreciation, the real wage gains, et cetera. But bottom line, the debt service as a percent of personal income is not at scary levels.
Okay, so the consumer isn't necessarily in an overextended position. What about corporate health? Peter, can you dive in there?
Yeah, thank you, Vanessa. So corporations are actually doing quite well. They're the bigger corporations too, extremely well capitalized. They've termed out their debt, so they've locked in kind of lower interest payments. or debt service into the future over a long period of time. So that's really helped insulate them from the rising interest rate environment. We've had, resurgence or it's starting to pick up more of stock buybacks, which is good and helps reward shareholders. And then finally, a lot of the return that we've had recently, over the last 4 years, S&P's up about 58% or so. About 51% of that comes from earnings, and the other 7% from margin expansion. So you hear a lot about, hey, it's just, the market's going up because multiples are expanding or margin expansion, and that's not necessarily the entire story. We're also starting to see, the economy in good shape, as Steve just outlined. And so we're starting to see earnings actually start to accelerate, which could be a real positive for returns. And then finally, corporations too, they've been able to right-size their businesses quite a bit through layoffs, becoming more efficient, which actually, flows through the bottom line. So you've seen this a lot, specifically in larger cap technology companies. They've been able to kind of get religion from the previous hiring booms that they've had and really cutting staff and making the business more efficient, which is really beneficial for corporate earnings and ultimately shareholders.
Okay, so Steve, do you think we might see a resurgence in inflation in 2024?
No, we don't think so. I mean, inflation took a real U-turn in 2023, and it continues to normalize. Goods prices are in decline. Service sector prices are stabilizing. And this normalization is leading to decent gains in the real incomes for the employed consumers, which is a good thing. In the background, there's actually a risk of deflation building as the overcapacity and overproduction in China is resulting in their maybe dumping goods into other countries to get the flow of goods out of their factories. But that being said, there's probably to be offsetting tariffs applied if that were to happen between us and China. It's happened before. And similarly, the application of AI and productivity improvements that Peter talked about help keep a lid on rising prices to the consumer, because even if you have rising prices on the goods levels, the components of manufacturing, if your productivity is bounding ahead, that doesn't result in higher prices to the consumer.
So that brings up our next question: as inflation rates are coming down, and the Federal Reserve is currently has monetary policy at 5.25 to 5.5, then rates are restrictive on economic activity. So they're very tight. So does this indicate that we'll have a Fed pivot anytime soon?
Yeah, everyone knows the Fed doesn't want to be too early in cutting rates because nobody wants to repeat the late 70s, early 80s in inflation. We know that, we get that. But there's a good bet they'll be lower in 12 months. And the question is when and by what amount? And everyone likes to talk about the Fed being forced to lower rates, but I think they really want to lower rates because inflation's near target. If you take a look at the annualized CPI numbers using the last 3-month average of reported CPI, you take a look at most of the forecasts. So inflation's near target. And they have a 5.25%, 5.5% Fed funds rate, as you mentioned, and that represents a pretty nice spread over the current inflation rates. And if you drop that inflation number by yet another 1%, that spread just widens. And history proves that the spread we're at right now is a spread where they're comfortable with. And there's no reason, they don't need to keep rates high, so they will probably want to follow the inflation rate a bit lower. And that'll put downward pressure on yields, likely across the board on the yield curve, but more certainly on the shorter term bond yields.
So I think to summarize then, recessions, whether one's imminent or not, or they do happen, they do happen in the future. The laws of economics and the business cycle aren't repealed, so we have expansions and contractions. But then one is probably not imminent today, given the strength in the economy, declining inflation, and potentially a Fed pivot.
Yeah, I agree. Um, let's talk a little bit about how we've structured our portfolios to weather different environments. Specifically, let's talk about what we're doing in client portfolios and individual securities. Peter?
Yeah, so first and foremost, we always really focus on quality. So we're focusing on quality cash flow, quality businesses with strong cash flows, shareholder-oriented management teams. So they're looking at returning cash flow to share owners through buybacks, dividends, or positive reinvestment within the business. And really staying in, companies that do represent quality with sound balance sheets as well. And that can have the wherewithal to stand the gyrations of economic activity.
You're right, Peter. How corporations run themselves in the face of rising input costs through the application of AI, something we've talked about in our investment meetings for the last number of months, and other productivity enhancements. It's how they can maintain their margins and deliver more value to investors, really despite what the economy throws at them. And that's why we place such an emphasis on companies with very strong management teams.
Yeah. Well, I think the key is to have a multitude of different tools. And certainly that's something we focus on at HoyleCohen, whether it's active or passive funds, individual stocks and bonds. We've also introduced a host of alternative investments, including private credit, real estate, private equity. The intent being, if you can introduce more things into a portfolio that have lower correlation, you can potentially reduce the overall risk and the volatility within the portfolio. So there are a lot of different levers that we can pull. We're always looking at portfolios and determining whether it's time to rebalance and trim, whether we're able to deploy assets into more favorable areas of the market. And we're just looking to meet each client's risk and return objectives with something in the portfolio that can help meet that need. And the key is really just to stay diversified, invest for the long term, and certainly to focus on that after tax, after inflation, risk adjusted return. So if you're interested in discussing that further, don't hesitate to contact your HoyleCohen advisor or to listen to other short videos that we have posted to hear more of our thoughts. What's next for stocks, Peter?
Thank you, Vanessa. So, stocks are looking good and favorable for the year. We are still in the expansion territory off of the bear market lows of October 22. Last year, we saw strength through the beginning of the year, only to come down through the second third of the year, and then again a bottoming in October of 2023, and saw a really healthy expansion into November and December. That continues today, which is good. So we have improvement, and that continuation in stock trends is really supported by that disinflationary trend where we have inflation rates coming down, which is a positive. The Fed is done raising interest rates, which again is another positive, and may in fact pivot and start cutting rates this year. And finally, corporate earnings and corporate health are strong, which gives a good support to rising stock prices. I think through the year, we may see some volatility, given that right now there's a lot of euphoria in the system. So sentiment gauges are very, very high or very bullish. And usually that's a contrarian indicator. So, more people are in stocks and stuff, so it can predicate some weakness, but that weakness will most likely be short-lived. The other concern this year is all the geopolitical risks that's out there that we all know about. And then also we're in an election year, and elections are always interesting. This year may be a little bit more, so that can cause some weakness kind of mid-year. But I think then we get past it, we end up at the end of the year with another strong, hopefully finishing for 2024.
Those are really good points. And one of the key questions out there about stocks at this level is, are they overvalued? And we saw this valuation expansion really accelerate since October of last year. And maybe, some parts of the market are overvalued based on where earnings are today. But behind the scenes, productivity has been improving at a fairly rapid pace. And a number of companies are pointing to some higher profits, which you'd hope it would relate to higher prices in stocks. But that with the employee count reductions, it's a good setup for many companies. But are valuations elevated? Yeah, one has to say they are rather elevated today.
I agree, but with valuations being high, it's not necessarily a timing tool, and I think earnings will grow into the valuations, and then earnings can furtherly be boosted by the improvements in productivity, the advent of AI, which can improve that, and finally, some of these labor reductions or layoffs or kind of right-sizing businesses can make businesses much more profitable by improving margins. So that should be a good tailwind for the year.
Steve, can you talk a little bit about Wall Street earnings expectations and how we may see some price improvement based on those expectations, potentially having upward revisions?
Yeah, and it's something that's been vacant in the last 6 months because I follow the earnings per share estimates from the analysts fairly closely, and throughout the last part of 2023, there were no increases in the earnings expectations for 2024. It was all valuation expansion in the market, and the analysts have been pretty stubborn in putting forth EPS expectation increases. Even for 2025, they're just up slightly. But it looks like back-to-back double-digit gains in earnings per share, 2024 and 2025. All else being equal, if you increase earnings, let's just take it 10% a year, and price-earnings ratios stay the same, what's that do to stock prices with the same PE? So that's where, Peter, your comments about companies growing into their valuations, that's probably what we're going to see, and then we'll get a little bit of optimism. You would think back into the market for stocks as the economy goes through its soft landing or no landing, and it looks like a pretty good environment for stocks going forward.
Right.
And Mark,
well, let's extend our conversation kind of beyond the large cap US stocks that really have dominated the headlines in the past year. We've had a market with extreme concentration. We've heard a lot about the Magnificent Seven large tech companies that have dominated in terms of stock price movement. And they've been driving the S&P 500 return. But, there's another 493 stocks. 490 of them really haven't had as much pricing movement as the others. So I think we take a moment to focus on where the PE, the price to earnings, or the valuation is. Those stocks have literally almost double the PEs of international emerging market and certainly some opportunities in the mid and small cap US market. So if we're out there trying to buy $1 worth of earnings, we're able to extend our view and have a greater opportunity set from which to invest. And if the economy does well, markets broadening out, we would expect that more companies would participate in that positive and significant opportunity.
thank you. Yes, we're trying to really focus on companies that are really going to benefit by changes in the overall economy, and that's really productivity enhancing businesses such as technology, where they're implementing now artificial intelligence to improve workflows and efficiency, and those will be great areas. The other areas in the market too represents valuation disparities, so like what you're talking about within the small caps and mid caps, and those are opportunities too, which should be supported by a declining interest rate environment. So I think there's a lot of opportunities in today's market.
I've heard you talk a lot about AI, specifically in the fact that at this point in time, the companies that are at the digital forefront, the companies that are actually developing the AI, are the ones that have seen the benefits. And we may actually start to see the productivity enhancements from the users of AI. So I think that's another really interesting trend that could develop this year and into the future.
Exactly. It's seeing the integration and being able to apply that efficiency to the businesses, and then finally, increasing kind of user engagement and things like that. So it's still in its infancy, early innings, and there's going to be a huge evolution, but we're excited to be participating in a lot of those businesses and kind of watching it as it enhances overall productivity for the economy.
I think it's an interesting theme. You talk about thematics issues, and that's going forward. That is going to be key to which companies, which management teams can hone their corporations to produce, the most profits with, from every dollar of revenue. And in this, in this valuation mismatch, Vanessa, you brought up, it's at its widest gap than we've seen in years. The difference between international large cap in the S&P 500, emerging markets in the S&P 500, and even small and mid cap companies in the S&P 500. Everywhere you go, this broadening of market participation should lead to more companies. To the other 493 companies. These companies should perform as the economy broadens, and they're able to use the tools to increase their productivity. And one would think that the valuation would find those companies, certainly. And it's always an interesting balance as, we manage client portfolios, because there's the fear of missing out countered with the fear of paying tax. If you own some of these the Magnificent Seven or the Fabulous Four or the top 10, taxable clients have very large capital gains in these issues. And the challenging thing going forward is, at what point does the broadening of participation in the markets come to a point where it makes sense to take some profits and realize some gains and redistribute the proceeds amongst some of the stocks that are great companies, but just haven't performed. And that's a very individual decision, based on the client advisor relationship and, where the client is with respect to all of their estate plans.
Those are great points. And I think it comes back to, in my mind, that, investing requires a lot of patience. We have to have perspective too on kind of the landscape, as we've been discussing, what opportunities are out there, looking at the different inputs of valuation, interest rates and whatnot, inflation, of course, but then also the persistence, and as managers trying to be persistent with our methodology, working with clients to understand what their risk tolerances and investment objectives are, because they're unique to every individual. And then we tailor the portfolios to meet those needs. I think in aggregate, this year is looking to be potentially a good year again with those longer term trends, where we have, the disinflationary trend, the Fed potentially cutting, a resurgence in corporate profits. We have good consumer health right now. Yes, there's worries on the landscape, as there always are, as markets are always, climbing a wall of worry, as they say. But we will get through. We'll get through the election, the different volatility periods. The most important thing in my mind is really focusing on that long term. Again, having the patience to get there, the perspective and the perseverance.